Grand Rising, good afternoon, and good evening to you. I'm Ty, and I'm the CEO of TBD Gen Wealth. Why TBD? Because generational wealth is still to be determined. I'll repeat that. Generational wealth is still to be determined, meaning the generations to come, the wealth of the generations to come is determined by you. In a short poem, Invictus, written by William Ernest Henley, he wrote, "I am the master of my fate. I am the captain of my soul." I want you to think about that when you're doing your long and your short-term investing. Think about everything you do from right here on is for the generations to come. Now that we got that out the way, I want you to think about, why are you doing options trading? I want you to pause the video right here, and I want you to write down your long and your short-term goals. Quick disclaimer, I am not a financial advisor. I am not a fiduciary. Everything in this options course is my opinion and for entertainment purposes only. Please move forward in this options course at your own risk. And remember, never invest what you can't afford to lose. I'll see you on the next video. Okay, so what I want you to take from call option slide is that we only purchase call options when we believe that the current stock that we're looking at is going to move up in price. What do I mean by that? We believe that stock A is going to go from $50 to $55. We believe that stock A is going to go from $100 to $110. Now, how do we come to that conclusion? We come to that conclusion in two different ways: through fundamental analysis and or technical analysis. So for our fundamental analysis, we're doing our research, we're looking at our 10Ks, our 10Qs, our 8Ks. We see that there's no debt. We see that they have good assets. We see that they have good earnings. We see that there's a possible merger coming. We see that investors are loving this company and they're going to invest large sums of money into them. We see that there's FDA approval. We see all these different things that are leading us to believe that this stock is now going to move up in price. Now, if we go from a technical analysis, we have our support and resistance lines. We have our Bollinger Bands. We have our moving averages. We have all these indicators that we're looking at on our chart. And we're saying, okay, this stock is hitting our support line. We see it bouncing off our support line and moving in an upward trend. So we're going to get in at a low point and we're going to ride it up. Okay. We see this stock within our Bollinger Band is getting ready to hit our lower band, and we see it bouncing off of the lower band and we're going to ride it up. Okay. So we're going to use either our fundamental or our technical analysis to get into a stock at a low point, and we're going to ride it up. We're going to take our fundamental analysis and our technical analysis, and we're going to get into a stock at a low point, and we're going to ride it up. You can use either one. You can use them both. Okay? See you in the next video. Okay, so the last video we talked about call options and how we was looking at stock price going up in price. For put options, it's the exact opposite. We're looking at stocks going down in price. It's why they say we can make money in the stock market when prices go up. We can make money in the stock market when prices go down. So for put options, when we look at our fundamental and technical analysis, we see that the stock in question had a merger going through. One of the companies pulled out of the merger, so stock A is now going to drop in price. We see that the stock in question had investors, but the investors didn't like what was going on with the company, so they're going to pull large sums of money from the company. It's going to cause the stock price to drop also. We see that the stock in question had an FDA approval in their line of sight, but the FDA approval got denied, you got it. Stock price is going to drop in price. Okay? We're looking at our 10Ks and our 10Qs, and we see that the stock in question has an insurmountable amount of debt that they can't overcome, and through a period of time, that stock is going to come down in price. Now, if we look at our technical analysis, and we're looking at our support and resistance lines, and we see that a stock is going to a resistance line, and in the past, when it hit that resistance line, it dropped down in price. We see it starting to do the same thing. It hit the resistance line. It started a trend downward. We're going to get in at a high point, and we're going to ride it down. Now, looking at our Bollinger Bands, we see a stock hitting the upper band, and we see it starting to change directions and trend downward. We're going to get in at that high price, and we're going to ride it down again. Okay? So for put options and for call options, we can look at either our fundamental analysis, we can look at our technical analysis, we look at them both together, but look at something. Never go into an option, call or put, and say, okay, this stock is rising, I don't know why it's rising, this stock is falling, I don't know why it's falling, but I'm just going to try and ride the wave. Because once you start trying to ride the wave, you're going to get into a bad habit. You might win a couple times, but I guarantee you'll probably lose a lot more than you'll win. Because as soon as you try to ride that wave, you probably got in too late. And if you get in too late, that stock, whatever way you're trying to ride it, it's going to change direction and it'll go the other way. Or it'll stall out, and then now you got to worry about time decay. And we'll talk about that later on. See you in the next video. Welcome back, welcome back, welcome back. All right, so on this slide, we're going to talk about picking your strike price and your expiration date. So within picking your strike price, you got 3 different strike prices you can choose from. You have your in the money, your out the money, and your near the money strike price. For your expiration dates, you have your weekly, you have your monthly, you have a couple months, you have a year, you have 2 years. That's all preset and predetermined within the options chain. Okay? So for your strike prices, let me show you what your in the money, out the money, and near the money look like. So we have a stock that's currently trading at $447. For calls, your in the money strike price is anything that's less than the actual stock price. Your near the money strike price is anything that's higher than but close to the actual strike price. And then your out the money strike price, anything that's higher than and further out from your strike price. Okay? So now we're going to go over to puts. Your in the money puts strike price is anything that's higher than the actual strike price. Your near the money strike price puts are anything that's less than but close to the actual strike price. And then your out the money strike price for puts is anything that's less than and further away from the current stock price. Okay? So now, when we talk about contracts, right? So each contract has 100 shares of the current stock in it. Okay? Each contract has 100 shares of the current stock in it. So for contracts, we look at ask and bid prices. Okay? So your ask price is what the seller wants to sell you each share for, or the bid price is what you want to pay for each share. So currently, if we look at the $455 strike price for calls, they're asking for $4.25 per share. Now you have to buy the 100 shares, so you times that by 100. They're asking you to pay $425 for that contract. Make sense? Okay. I think that's it for this one. I'm going to do a follow-up video to go a little bit more in depth with the strike price and expiration date and what happens if you pick a strike price closer to an expiration date and then it stalls out. And then we're going to talk about a little bit of time decay. Okay? See y'all next video. What's good, people? All right, welcome back. So last slide, we talked about strike price. We talked about in the money, out the money, near the money strike prices. Talked to you about your calls and your puts. I talked to you about your ask and your bid prices. We mentioned that each contract has 100 shares, okay? At the end of last video, I talked about how I will go a little bit deeper on what time decay is and why you need to have a further out expiration date so you don't have time decay affect your options. All right, so what's time decay and how does buying an option at the current price, the current day, affect you when your expiration date is close, okay? So think about it. You have a contract. The closer you get to your expiration date, you have a contract. The closer you get to your expiration date, the less valuable your contract then becomes. I'll repeat that. You have a contract that's worth $500. The closer you get to the expiration date, the less valuable it becomes. So each day you have that contract goes from $500 to $495 to $490, so on and so forth. So please never hold a contract to the very last day. Your contract will go from $500 to being worth $0 if you wait to the very last day. Okay? All right, so I'm going to go ahead and share my screen so we can go a little deeper into all of this. All right, so on the screen, you see that we currently have a strike price of $455. We have the ask price for that strike at $4.25 times 100 for each share, 425. We have a bid price of $4.10 per share times 100, 410. Okay. We have an expiration date of August 14th. The current price is $447. Now we do a limit order for $4.20 per share for that contract, times that by 100 for each share in the contract, that's $420. Okay, so your $455 strike price call option contract today is worth $420. So you start today with it worth $420 at the current price of $447. If you end the day at $447 for that current stock price, your contract will be worth less. Let me explain that another way. You start today with a current stock price of $447. You need that stock price to go to $449 to gain 10 cents on each share in the contract. If it does not get to $449 and it stays at $447, each share in that contract will now be worth $4.10 because you will now have a less valuable contract because it did not move and it's a day closer to the expiration date. Okay, so you start day one, it's worth 420. You end day one at the same exact stock price, it's now worth 410. You start day two with a 10 cents less than what it currently cost each share the previous day. So now you have to move up even further on your current stock price to get back what you lost the previous day. That makes sense? So day two opens. Each share is now worth $4.10. You had to get to $449 to gain 10 cents on each share. So now you have to get to that $449 to gain that 10 cents back. And then you got to go to $451 to get 10 cents of profit on it. But what happens if you don't? Now your contract is worth even less. So now it's worth $4, right? So now you have to, on the third day, go even higher in price. So instead of gaining money on that $449, instead of gaining money on that $451, you now have to try to gain money on that $453 or $454. The closer you get to your expiration date, the less valuable that contract becomes. So you now, instead of it going up $2 and you gain, you now needed to go up $7 to gain. You now needed to go up $8 to gain. Okay? So remember, people, never wait till the last minute to sell your contract. Never buy a contract unless you know the stock price is going to actually move up quicker if you have an expiration date that close. That's why we always say buy contracts with further out expiration dates so your time decay then does not become a factor in day increments. It's now a factor in week increments. Okay? All right. So I appreciate y'all taking your time to watch this video and understand a little bit more in detail on time decay, a little bit more in detail on why we do what we do. Stay tuned for the next one, and see y'all in the next video. Welcome back. All right, so in the previous slides, we done talked about a lot of stuff. We done talked about options and what they are. We done talked about call options. We done talked about put options. We done talked about strike prices. We done talked about expiration dates. We done talked about in the money, out the money, near the money. We done talked about time decay. Talked about a whole bunch of stuff. But in order for us to complete this options course, we have to talk about candlesticks. We have to transition over to a technical analysis piece. And in order to do that, we need to first understand what candlesticks are, what they look like when they're complete, and what happens during their time frames. All right. So for a green candle, bullish. For a red candle, bearish. All right. This is the body of the candle. So let's give an example. Let's say this is a 5-minute time frame for this candle. Okay. The candle opened at $10. During that 5-minute time frame, that candle pushed down to $8. Sometime during that 5-minute time frame, that candle pushed all the way up to $14, and it finally settled at the 5-minute mark when it closed at $12. So in that 5 minutes, that candle opened at 10, pushed down to 8, pushed all the way up to 14, pushed and settled right back down to 12. All right, let's go over to the bearish. Same 5-minute time frame. Okay, candle opens at 10. During that time, it pushed up to 14, came all the way back down to 5, and it closed at 8. So during that time frame, opens at 10, pushes up to 14, down to 5, settles and closes at 8. It's that simple. It's that simple. So for our candlesticks, we have a high, we have a close, we have an open, we have a low. We have the lower wicks, we have the body, the upper wicks. For our red candles, we have the high, we have the open, we have the close, and we have the low. What more do you need to know? If you need to know more information, please reach out to me. All right? See y'all in the next video. All right, people, we are ready to put on our indicators. All right, so this is Tesla, and this is in Think or Swim. So I want y'all to come over here to Edit Studies. Come up here to the search bar, and we're going to put in MOV, AVG, EXPO. Double click, backspace. Put in BOLL, Bollinger Bands. Backspace. We're going to put in the RSI, your relative strength index, letting you know if a stock is being overbought or oversold. Double click. Backspace. Finally, our MACD. Double click. Our MACD is showing momentum. It's your moving average convergence and divergence. It's showing momentum of if the stock is going up or if momentum of the stock is going down. So for your moving average, I want you to have one on 20 or 50, whichever one you like to look at. I look at the 20 because I know I do all my charting on 20-day charts. Okay? This stuff is normally going to come at 9, I believe, is the default setting. Change to 20. Hit OK. Come to the next one. Change it to 200. All right. After you do 200, change the color. Here you go. OK. Then you're going to come down to your Bollinger Bands. Your Bollinger Bands are going to be one indicator that's showing your support and resistance lines. Okay. You come over here, Studies. Change this to 2.5. And then change this to 2.5. Why are we changing this to 2.5? So naturally, default setting is 2.0, but we're going to change it to 2.5 so we have a little bit more room to play with when it comes to our support and resistance lines. Okay, we keep it at 2.0. If we keep it at 2.0 and the stock is dropping and it drops and it falls at the line or below the line, 9 times out of 10, we're all going to think, okay, this stock right here is under the Bollinger Band or it's above the Bollinger Band, buy, and then it keeps on dropping. And then you'll be like, dang, what happened? Just a little bit more space, a little bit more room, move to 2.5. The max move it to is 3, but I think 2.5 is pretty safe. But this is what I do. This is what I do. You can start off with 2.0. You can watch it. Like, okay, I like this. You can move to 2.5. You can move to 3.0. Do what you want. I'm telling you what I do. Okay? And then the length, keep it at 20. That's the moving average. Now, if you're doing the 50-day moving average, I'll probably move that up to 50. Okay? Then you're going to come down here. You're going to change this to yellow. I'm changing it to yellow, so my Bollinger Bands, my moving averages, and then my support and resistance lines that I plot myself are all different colors, so nothing's confusing. Then you're going to hit OK. You're going to hit Apply. Then you're going to hit OK. All right, So now we're going to go into plotting our support and resistance lines. So what I do, I start off, I plot my high, okay, double click, right click, extend to the left. I plot my low, double click, right click, extend to the left. And then I go through and I plot anything that has an extreme change in direction. This came down, stopped, went right back up, okay? Double click, right click, extend to the left. It's going up, came right back down. I'm gonna plot it. Double click, right click, extend to the left. I see right here, went up, came back down. What we're gonna do, we're gonna plot that. Double click, right click, extend to the left. That's close enough for right there. That hits right here. It goes up. Boom. Plot that. Double click, right click, extend to the left. Going through. Anything else we see, we should be good right here. Okay. Real quick, real down and dirty. If you see more, plot more. If you see less, take some out. This is how I do mine, okay? So now how do we use all this to get into options trading? Okay, so we using everything. You don't just use one indicator, okay? Use one indicator. It could be a false, could be perfect, and it could be good. But we need to use multiple indicators to verify that what we're looking at is true. So right here, it's going up. It hits the top of the Bollinger Band. It hits our resistance line. It's overbought. And it's getting ready to cross back over, back under the MACD line, okay? So that's letting us know it's about to be a sell-off, so we can get in for a put. And then you write it down. Right here, hits a support line. It's not all the way down here yet, but we know it is still low. So what do? You can buy in if you want, or you can stay away and you can watch and see what the stock does. So it goes, it plays around, plays around, plays around. Now it's sideways. It hits the bottom of it. It's in the middle. Down here on our MACD, it's crossing over. And then it goes for a run. It breaks this support. It breaks this resistance. It breaks this resistance. And it stops on this resistance and comes back down. So we could have watched it hit the bottom of this Bollinger Band. We could have saw that it broke here on this strong bullish candle, and it closed above the bullish candle, and we could have rolled that up right here. Okay, this is how you use your support. This is how you use your resistance. This is how you use your Bollinger Bands and all that. Okay, so RSI, when it's over 70, it's overbought. When it's under 30, it's oversold. When it's overbought, there's going to be a sell-off. When it's oversold, there's going to be a buyback. All right. I hope that made sense to y'all. Once again, if y'all have any questions, please let me know, and I will be sure to explain it in further detail. But until next time, I'll see y'all later. Oh man, we done made it to the end. This is the last video. We're done. We are done. We can now put in a contract for a call or for a put. That's it. I'm going to show you how to do it. We're going to take our fundamental analysis. We're going to take our technical analysis. We're going to say, all right, we know we want to get a call option because we know the stock price is going to go up. We know we're going to get a put option because we know the stock price is going to go down. We're going to say, all right, I want to get this strike price because I think this is where it's going to hit. We know we're going to go for a bid price of XYZ because we're not trying to spend all the money that they're asking for. So we're going to do a limit order. Okay. Let's see what else. We're going to have an expiration date that's far enough out so we don't have to worry about that time decay hitting us every single day. We're going to look at our support lines. We're going to look at our resistance lines. We're going to look at our Bollinger Bands. We're going to look at our moving averages. We're going to look at our RSI. We're going to look at our MACD. We're going to see that this company is merging with this one. We're going to see that this company's got an FDA approval coming up. We good. Let me show y'all. All right. So right on here, this is where you can change it, and you can change it your call. You can change it for puts. You can have both in here. I normally just set it up for one or the other. I know if I'm going to do a call, put it on call. If I'm going to do a put it on put. Okay. So for Tesla, we did all of our stuff, right? We know Tesla's doing good. Tesla got an earning call coming up soon. We know Tesla has been trading fairly well. It's been going up. It's been going down. So we say by January 2021, Tesla's going to hit, in our mind, we're saying Tesla's going to hit $1,600 by January 2021. All right, so what are we going to do? We're going to come down here to January 15th, 2021. Open that up. So all this right here in the blue is all of your in-the-money contracts. But we're not going to do in-the-money. In-the-money is way too expensive for our blood. So we're going to come down here. We're going to go to 1,600, $235 per share. Now, this is just an example. Just an example. All right? $235 per share. So that's around about, for one contract, $23,000. Remember, this is just an example. Tesla's already trading at $1,400. So these contracts are going to be a little bit more expensive. Remember, the further out you are, the more expensive it's going to be. The closer you are, the cheaper it's going to be. But the closer you are, the more time decay you got to worry about. Okay? So for stocks like Tesla, stocks like Amazon, that swing really far, up or down. Their options, their contracts are going to be more expensive. But just an example, okay? So we're going to click on it, and it's going to pull up your order form, all right? So right here, we're going to look, single. We're going to go to buy. We're going to come over here, and we're going to change this to whatever we want, however many contracts we want. For this example, we're going to say one contract. We're going to go over here. We're going to go to open. So when you're buying a contract, it's buy to open. When you're selling a contract, it's sell to close. So we're buying a call, buy to open. We're going to buy a put, buy to open. When we're selling them and ready to get out of them and make our profit, sell to close. Okay? All right. So now we're going to verify. We have Tesla. We have the expiration date that we wanted, the strike price we wanted. We want a call. All right. So right here, the ask price was $23.5, but we don't want to spend $23.5 on that. Why? We want it to be lower. So we're going to do this limit, and we're going to bring it down some. We're going to try and get a discount on what they're offering, okay? We like discounts. We never want to spend exactly what the market is trying to give us. So let's bring it down to 23.3, all right? So it's a limit order right here. You do a market, don't do a market. Always limit. So day or GTC. So day is saying if this contract does not get filled from the time that the market opens to the time that the market closes. In that specific day, this contract will be canceled. Okay? GTC is saying if this doesn't get filled from that day to close, from the next day to close, from the next day to close, the only way this contract will be canceled is if you go in here and you cancel it yourself. So it's going to stay open for somebody to buy it, or somebody to say, okay, yes, I will sell this to you and you will have it. Until somebody does that, it will stay there. If nobody does it, you need to go on in there, cancel it yourself, put another contract in there, and then come up on the price. That's probably what it is. If it's trading higher, they're probably like, nah, we're not coming down that low. Come up and meet us where we are. You don't have to be exactly where they are, but just within, a couple dollars. All right? So we're going to have day, and then here, once you hit this button, it's going to pull up a receipt, and it's going to show you exactly what your max profit is. It's going to show you what you can lose on this contract. Boom. Right here. So your max profit on this call for January 15, 2021 is infinite. Why? Because Tesla can just shoot all the way up, go to $3,000, $4,000, whatever by January 15th. So there's an unlimited amount of money that you can make on this one contract. Your max loss is what you put in. You put in 23,000, you're only going to lose 23,000. Like I said, this is just an example, okay? Now, if you have 23,000 to put on Tesla, let me know what you do, and let's talk. So, and then from there, you're going to hit send, and then you're done, all right? That's it. It's that simple. That simple. Okay, so since you all stayed here, since you all support me, I'm going to show y'all one more thing that option traders use to help us when it comes to doing options. Boom. Option profit calculator. So we come here, put in the stock symbol, the ticker symbol, hit get price. Over here, we're gonna go to that date that we had. We're gonna come down to the strike price. What was it, 1600? Boom. Now, if it did get filled at that 23.3, we're gonna change that. Hit calculate, and now it's gonna pull up exactly what you can make, and it's gonna show you up here your time decay. So right here, having your expiration date all the way out in January, your time decay is now hit every week, every 6 days, okay? So you don't have to worry about it being every day that you're getting hit. Now it's every 6 days you get hit. So now you have that room for the stock to play around, You have that room for the stock to go down a little bit, come back up, go down a little bit, come back up. And while it's doing that, if you see it at a certain price, go ahead and sell it. Take your profit. You don't have to wait all the way over here. You can wait till October. You wait till September. If 14 October, it goes up to $1,600 and you make your money, sell. All right. Shoot, if it went up to $1,600 within that time, that's $7,000. Come on now. Who's not going to take that? No, I would. So I'm going to show you why we don't have an expiration date that's real close. So come back, that same strike price. It's way cheaper, right? It was $23,000 for so far out. Now it's $700 because it's so close. But look at this. Each day, you got to worry about that time decay. Each day. Closes out, If it went up, cool, closes out, opens at the same price next day, you're already down $70. Closes out next day, you're already down $320. And then now you need it to go up to $14.94 to get some type of profit. You need it to go to $14.85 to break even. So this is why we have a further out expiration date, so we don't have to worry about that. Well, shoot. I'm glad y'all stayed in. I'm glad y'all rock with me. Y'all supported me. If y'all have any questions, you know where to find me. That's it. Thank you again. Yeah, happy trading. Remember, never invest what you can't afford to lose. All right, y'all. I'm out. Oh, man.